Main Street stock, ticker symbol MAIN. This stock pays a juicy monthly dividend of 6.4%, which is of course an insane number. On the 23rd of February, Main Street reported earnings where they beat on both EPS and revenue, which is of course very nice. For the upcoming earnings, all 5 analysts expect a beat again, which is also pretty interesting. The stock is up almost 7% year to date, which is mostly because of positive earnings. The overall market, in this case the S&P 500, is up only 2.5%, so Main Street is doing a better job most recently. But does this mean that Main Street stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Main Street does. The most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Main Street do? Main Street provides one-stop capital solutions, private debt and private equity capital, to lower middle market companies and debt capital to middle market companies. Main Street's lower middle market companies generally have an annual revenue between 10 and 150 million. When we dive in the most recent earnings, we see that total investment income is up 39% year over year, which is very nice in my opinion. A very important metric with companies like Main Street is distributable net investment income, or DNII. We see that this number is up 46% year over year, and in DNII margin increased 376 bps, which is also very nice. Another interesting thing that I like to see is that the net increase in net assets and net investment income per share. Both are increasing quite a bit, so bottom line DNII per share also increased 32%. This comforts me a lot, and to be honest. Especially since dividends are covered very well, with the DNII sitting around $1, while dividends is at $0.67. So you have a payout ratio around 70%, which is also very nice for these type of companies. To me, it's very important that debt is covered very well, with these type of companies of course, since they issue a lot of new shares to raise capital and issue a lot of new debt. But as long as the debt is covered, I don't mind that much. The debt to NAV, net asset value, is at 0.95 to 1, which is a great number for these type of companies. You want this number below 1, so they are doing a good job here. A thing that I also like is the fact that DNII per share and net value assets per share has increased quite steady and consistent over a longer period of time. Next to that, the monthly dividends have increased quite a lot as well alongside with it. So this looks really good to me. Of course, there are 2 big declines which are related to the housing market crisis and the lockdown periods. Other than that, it looks really great. Another thing that is really great with this company is that they do like to pay supplemental dividends. So you're already receiving a great dividend yield every month, but on top of that you will get another extra dividend. But to support all this, you want to minimize the risk with this company. One of the things that they do is diversification. There's no industry bigger than 8% within their portfolio, so this looks really good to me. No high exposure to single industries. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Main Street is a 3.29 billion market cap company. PE ratio is at 13, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for Main Street, so make sure to watch until the end. Because PE ratio is only telling a small part of the full story here. Revenue is at 331 million, and in this graph we see that revenue went up in the long run. During the lockdown periods revenue went down a bit, and right now revenue is growing again at high numbers, so this looks really good to me. Margins are going up and down quite a bit, so it's not really steady and consistent. Since 2021 it's going down again, which is of course something to keep your eye on. During the lockdown periods margins went down big time, but it's good to see that they went up after things cooled down, so nothing to worry about. EPS is also going up and down quite a bit, but in the long run it's not really steady and consistent. Nevertheless, it's nothing that worries me a lot. Analysts expect EPS to increase at double digits this year, but in 2024 it's expected to decrease. To me, it feels that out of these three analyses, one or two analyses are a bit pessimistic, which is okay of course, but could influence the number quite a bit since it's only 3 analyses in total. Revenue is expected to grow at 21% this year, which looks pretty good. And in 2024 it's the same story as with the EPS. Return on assets is sitting at minus 4.8%, which is not looking that good of course. But the most important number here for this type of company is the return on equity. It's sitting at 12%, which is a really good number, so this comforts me a lot. There's no ROIC reported since this is a finance company. Current ratio is at 1.35, which is very nice since it's below the 1.5 mark that I prefer, so this looks also quite good. Total debt is sitting at 2 billion and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at 49 million, so they can't pay down a big chunk of their total debt, which is something that I don't like. But earlier in this video we saw that net debt to net asset value is looking quite good, so it doesn't worry me a lot to see this debt. But it's still very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. In here we see that free cash flow isn't growing at all, so this does worry me a bit. I would like to see positive numbers here, so this is something to keep your eye on. Another thing that I don't like are the shares outstanding. It's going up quite a bit over a longer period of time. To me this is very important. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyway, dividend yield is sitting at 6.44%, which is an insane number of course. On top of that they pay a monthly dividend instead of a quarterly dividend. Annual payout is at $2.7 and payout ratio is at 70%, as we saw earlier in this video, so not the 78% displayed here. Usually this number is too high, since I prefer 50% or lower, but companies like Main Street have higher PE ratio in general, so it doesn't worry me at all. The 5-year growth rate is at 2%, which is not that high of course, but that doesn't bother me at all, since dividend yield is already very high. They grew the dividends for 2 years in a row. Overall a great looking dividend scorecard, but how about the historical returns? I decided to compare Main Street stock with the overall market, in this case the S&P 500. Next to that I added Ares Capital and Gladstone Investments. On the 5-year chart we see that Main Street had a return of 76% including dividends, versus the S&P 500 returning 53%. So they easily beaten the S&P 500. But both Ares and Gladstone had higher returns. On the 1-year chart it looks pretty different. Main Street returned 10% while the S&P 500 returned a minus 6.8%. Both Ares and Gladstone had a negative return as well. And it's pretty much the same story on the 6-month chart. Main Street returned 3% while all the others in this list had a negative return. On the 1-month chart we see that Main Street returned 2%, while again all the others had a negative return. So bottom line, Main Street did beat the S&P 500 in the long run, but not some competitors. However, in the short term they did better than the competitors. To me this looks pretty interesting. But is Main Street still a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6%, 7% and 8, since I think they will increase the revenue at lower numbers versus the historical averages. Profit margin I'm filling in 72, 74 and 76%. For the free cash flow margin I'm filling in 70, 72 and 74. However, we saw that free cash flow was negative, so it's something to keep your eye on. For the PE ratio I'm filling in 12, 13 and 14. And for the price to free cash flow I'm filling in the same numbers. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but with this company I want to build in a higher margin of safety. Right now Main Street is around $39. I hit analyze and we do see a few green numbers. We have a low price target of $35 to $36, which is a small drop from where they are right now. We have a mid price target of $40 to $41, which is slightly above the current stock price, and we have a high price target of $46 to $47. To me, the mid price target is the most justified here, since I expect the company will face some slowdown in revenue versus historical numbers. Based on these numbers, Main Street is slightly undervalued. Keep in mind this is with a higher margin of safety. My final conclusion is that I really like Main Street. I used to own this stock at the beginning of my investing journey. I bought it at a really low price and sold it from what I can remember around $40 to $50, since they seemed overvalued back then. At that price, of course. However, the company has developed quite well and is still capable of growing at decent numbers. Dividends are one of the main reasons why people invest in this company. Given the fact that they pay a monthly dividend at a high yield is of course very interesting. However, there are some risks of course with this company, such as debt, negative free cash flow and potential market crashes. Right now I think they are not massively undervalued, but since most people don't care about the ticker price at all and more about the dividends, I think this could be a great dividend stock. From a value point of investing, it's not that interesting. My golden rule is to have a cap of maximum 5% for these type of companies, because of the attached risks. So for now I'm keeping that on my watch list, since I'm already invested in some other high risk, high reward companies. But whenever the price drops a little bit more and I have some room to increase my positions, I will keep a close eye on this one, since they seem a great dividend stock. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.